Bismillahirrahmanirrahim. This is the fifth video on financial statement fraud. And in this video, we will continue discussing some more cases. We will discuss a case on the circuit board conundrum. We will discuss a case on the executive compensation. And finally, we will discuss a case on red flags of financial statement. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us start with the first case on the circuit board conundrum, financial statement fraud in a small town startup. Now in this case, the main fraud risk are the founders that held key roles, the CEO, COO, and the CFO, giving them too much control over finances. The board met rarely and had few members, which led to poor oversight. There was not enough check and safeguards to catch the fraud, and the bank's president on the board may have created conflict that affected oversight. So in short, the main issues are too much control by the founders, poor board oversight, weak internal controls, and potential conflicts of interest. So we have to identify the fraud exposures that are present in this case. Now the fraud symptoms in this case, they stem from several critical areas involving management, the board of directors, and external relationships. So let us make an in-depth explanation of these symptoms. Now the founders, they were friends, as you can see. They have worked together. And they held significant power in the company with roles that gave them control over financial reporting and operational decisions. Their personal relationships could have facilitated collusion, making it easier to commit fraud without detection. As the chairman and the CEO, the president and CEO, and controller and treasurer, the founders had substantial authority over company operations and financial reporting. Now, this concentration of power allowed them to influence decisions, bypass internal controls, and manipulate financial statements to benefit themselves personally. Now, since the founders owned a significant percentage of the company's common stock, this ownership provided a strong personal incentive to inflate the stock price through fraudulent financial reporting, as higher stock prices would directly benefit them financially. The founders made up a large percentage of the board of directors, so this created a situation where internal checks and balances were weakened. This insider dominance reduced the likelihood of independent scrutiny or challenge to their financial practices, facilitating their ability to perpetuate fraud. The appointment of the local bank's president to the board of directors is problematic too. Now, this individual has financial interest in the company due to the credit arrangements provided. Now, such a position could lead to conflict of interest as the bank president might have a vested interest in the company's financial stability and performance, potentially overlooking or rationalizing questionable financial practices to maintain favorable terms or relationships. The favorable credit arrangement from the bank, like extremely low interest rates or generous credit terms, could indicate potential issues with how transactions were conducted. Now, the company might have been receiving overly favorable terms due to the relationship with the bank president, raising questions about whether these terms were influenced by non business transactions or non business considerations. The relationship with the bank could create doubts about whether transactions between the company and the bank were conducted fairly and transparently. There could be concerns about whether the bank was providing unusually favorable terms due to the board members' influence or whether the company was engaging in transactions that were not in the best interest of either party. Then uh, the you can see over here the city in strong desire to keep the company in town due to its economic benefits such as job creation and local economic growth could create additional pressures. The city officials might have been motivated to overlook or downplay issues with the company's financial practices to preserve the economic benefits associated with the company's presence in the community. Now, by inflating uh, inventory values, the company can artificially boost reported assets and profitability. Now, this manipulation can rather mislead investors and lenders about the company's financial health. Understating the cost of goods sold by reducing cost of goods sold, the company shows higher gross margins and net income. This practice can deceive stakeholders into believing the company is more profitable than it truly is. So, these actions distort the company's financial performance metrics, potentially leading to poor investment decisions and incorrect valuations. So, the symptoms of fraud in this case are deeply connected to the power dynamics within the company and the relationships with external entities. The concentrated power among the founders, their personal financial stakes, and their control over the board led to weak internal controls and an environment conducive to fraud. Additionally, the relationships with the local bank and city officials, combined with potential conflicts of interest and non arm's length transactions, further compounded the risk of fraudulent activities. Addressing these issues would require enhancing internal controls, ensuring independent oversight, and scrutinizing external relationships to prevent and detect fraud. So, next, let us talk about the case on the executive compensation, uh, stock option backdating scandals. Now, in this case, uh, following the scandals like Enron and WorldCom, it was surprising to find that up to 20% of the public companies might have illegally backdated stock options. Now, stock options let employees buy company shares at a set price. For example, if a company's stock price was 15% on, say, January 1, 2007, and the CEO received options at this price, they could buy shares at 15 each, even if the market price rose to 35. allowing for substantial financial gain. Now, before 2006, the companies didn't have to report any expense for stock options if the grant price was the same as the market price. However, with the introduction of FAS 123R, options granted at a price below the market price had to be reported as a compensation expense. Uh, Now, fraudulent backdating involves companies with executives or board approval dating options as if they were granted on days when the stock price was lower. So, this manipulation ensures that the options would be profitable, violating accounting rules, tax laws, and SEC disclosure requirements. So in this case, we have to answer these questions. Would a good system of internal controls have prevented these fraudulent backdating practices? Now, good internal control are designed to prevent and detect errors and fraud, including procedures such as segregation of duties, proper authorizations, and regular audits. In theory, a robust system of internal controls could be effective at identifying and preventing fraudulent activities, including stock option backdating. Now, stock option backdating involves dating the options to a past date when the stock price was lower, ensuring that the options are in the money when exercised. This practice violates accounting standards, tax laws, and SEC disclosure requirements. Internal controls are less effective against fraud that involves collusion between multiple individuals, especially when these individuals include top executives or directors who have the power to override control. Executives and board members involved in backdating could override or manipulate internal controls, making them ineffective in preventing this type of fraud. So, if the internal controls were not specifically designed to address the risks associated with the stock option grants and their timing, they would be inadequate. For instance, if the approval process for stock options was not rigorously documented or monitored, it could be easier for fraudulent backdating to occur without detection. So, to conclude, while a good system of internal control might have detected and prevented backdating practices, if they were properly implemented and enforced, the effectiveness of these controls is significantly compromised when high level executives are involved and can override or evade them. So, why should executives and directors of so many companies have allowed this dishonest practice in their companies? And if you can recall from my previous videos, the fraud triangle model that explains why individuals commit fraud by identifying three key factors. First is pressure. The executives may feel pressured to enhance their compensation or meet performance targets. Now, this pressure can lead them to commit fraud if they see it as a way to achieve their goals. The second is opportunity. If there are weaknesses in the control systems or a lack of scrutiny, such as backdating options without detection, it provides an opportunity for fraud. Then, rationalization. Executives might justify their fraudulent actions by believing that everyone else is doing it or that is a common practice, thus minimizing their own sense of wrongdoing. So, even if many companies engage in similar fraudulent practices, it does not make those practices ethical or legal. Rationalization, such actions does not excuse the illegality or unethical nature of the behavior. So, backdating option allows executives to benefit from a lower exercise price, which increases their potential profit. The primary motivation is financial gain, as executives can make significant profits from options that are granted at a historically low price. Executives might have believed that the practice was low risk due to a lack of scrutiny or enforcement, particularly if backdating was a common practice among peers or in the industry. Many executives might have rationalized the practice by believing it was a customary practice or by thinking that since it wasn't being detected or punished widely, so it was acceptable. The widespread nature of the practice among companies could have contributed to this rationalization. In many cases, the board of directors or the compensation committees that should have provided oversight were either complicit or not diligent in their responsibilities. So, this lack of oversight can stem from a lack of expertise, conflicts of interest, or simply inadequate governance practices. To conclude, executives and directors allow fraudulent backdating due to financial incentives, perceived low risk of detection, and rationalization that the practice was acceptable or common. The absence of effective oversight and governance further enables the continuation of these practices. Let us move on to number 3. Would a whistleblower system have helped to prevent or reveal these dishonest practices? Now, a whistleblower system, this allows employees and other stakeholders to report unethical or illegal activities anonymously. Such systems can play a crucial role in identifying and addressing fraud. A well implemented whistleblower system could increase the likelihood of detecting backdating practices. Employees who observe or are aware of fraudulent activities could report them without fear of retaliation, which might lead to earlier detection. Knowing that there is a mechanism for reporting misconduct could deter individuals from engaging in fraudulent activities. The presence of a whistleblower system adds an additional layer of accountability and can act as a deterrent to potential wrongdoers. Now, for a whistleblower system to be effective, it must be well designed, confidential, and supported by a culture that encourages reporting and protects whistleblowers from retaliation. In environments where executives are involved in fraud, there might be a strong culture of fear or intimidating that could suppress whistleblowing system despite the uh, system being in place. So, a whistleblower system could have helped in revealing the fraudulent stock options, backdating practices by encouraging reports from insiders, and providing a means to detect such misconduct. However, its effectiveness would depend on the system's design, implementation, and the organizational culture surrounding it. In summary, internal controls might prevent backdating if properly designed and enforced, but their effectiveness is limited when high level executives can override them. Executives and directors allow fraudulent backdating due to financial incentives, perceived low risk, and rationalizations that the practice was acceptable or common. A whistleblower system can increase the likelihood of detecting and preventing such fraud, though its success would hinge on proper implementation and a supportive organizational culture. So, finally, let us discuss the case on red flags of financial statement fraud at ABC Company. Now, ABC Company is a successful software manufacturer and is planning an initial public offering for next semester, next September. Uh, the company has seen a significant increase in revenues and has incentivized its sales team with generous commissions and maintains close personal and social relations. The company recently changed its auditor after a dispute over revenue recognition rules, which raises some concern. Uh, Although the company has a broad board of directors and an audit committee, they only meet twice a year, though they plan to increase meetings in preparation for the IPO. So the board praises management and provides them with substantial stock options. So in this case, we have to identify the red flags that indicate that financial statement fraud may be occurring. And after analyzing the case, there are several potential red flags indicating that financial statement fraud might be occurring, and let us discuss these red flags based on the information provided. Now, the first thing you can see here is uh, that the company has changed their auditors. So, and they have changed these auditors due to a dispute with the previous audit partner over a strict revenue recognition rule. Now, a dispute over revenue recognition rules could indicate potential issues with how the company is recognizing revenue. Revenue recognition is a critical area where manipulation can occur, especially if there is pressure to meet financial targets or projections. Changing auditors in the face of disagreements about these rules could be a sign that the company was trying to avoid scrutiny or push through aggressive accounting practices. The company has implemented generous commissions for sales representatives to increase their selling efforts. So, while high commissions can motivate sales, they also create pressure on sales personnel to meet these targets. Now, this pressure can lead to unethical practices such as premature revenue recognition or booking sales that have not yet occurred to achieve sales targets and earn commissions. It is important to assess whether the company's revenue recognition practices align with accounting standards and whether sales practices are being pressured to meet high commission goals. Now the CEO relationships, the CEO, CFO, and CEO have been in business together for 20 years, including high school and college friendship, and their wives are also close. So, long standing personal relationships among top executives can create conflict of interest and a lack of objective oversight. When senior executives are closely connected, there is a risk of collusion or a culture of overlooking ethical boundaries. This can lead to financial statement manipulations and a lack of rigorous checks and balances. Now, the board of directors and audit committee meet only twice a year, with a plan to increase meeting to 4 times a year only in anticipation of a IPO. So, infrequent meetings of the board and audit committees may indicate a lack of thorough oversight and diligence in monitoring the company's financial practices. For a company preparing for an IPO, more frequent and detailed meetings are essential to address potential issues and ensure financial accuracy and compliance. The need to ramp up meetings only in anticipation of the IPO may suggest that oversight is reactive rather than proactive. Then look at the generous compensation with the stock options. So senior management, you can see, is generously compensated with the stock options for their good work. So while stock options can be legitimate form of compensation, they can also create incentives for management to engage in financial manipulations to boost stock prices before the IPO. If the value of stock options is a significant part of executive compensation, there may be increased pressure to artificially inflate financial results or manipulate earnings to enhance the company's valuation prior to the IPO. To summarize, changing auditors due to disagreements over revenue recognition rules could indicate potential manipulation in revenue reporting. Aggressive commission structures might lead to premature or fraudulent revenue recognition. Long standing personal relationships among executives may compromise independent oversight and create a risk of collusion. Rare board and audit committee meetings suggest insufficient oversight and could allow financial issues to go unchecked. Generous stock options might motivate management to manipulate financial results to maximize the stock value before the IPO. So each of these factors individually raises concern about potential financial statement fraud. When considered together, they suggest a high risk of unethical or fraudulent behavior. It is crucial for stakeholders, including potential investors and regulators, to conduct thorough due diligence and enhance oversight mechanisms to ensure financial integrity and compliance with accounting standards and regulations. So this completes the fifth video on financial statement fraud. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.